What's going on, guys? Welcome back to the Stock Talk podcast. We are on episode 4. We have some absolutely crazy things that we have to talk about for you guys today. Treasury bonds are pumping. Nvidia stock, it might crash or it might go higher. Tesla stock is something that you really have to go through in this video right here because the things that Nvidia just said at the CES in Las Vegas, it's absolutely mind-blowing, and this really could be really bad for Tesla in my opinion. So we're going to go through that too. And then we're going to go through what we feel like is going to happen in the market going forward for the next year because we have this constant battle between inflation and interest rates and what the Fed's going to do about it. So let's break all this down for you guys right here. What's going on, Cole?
What's up, guys? Yeah, this is our first episode of 2025. So this has been a little about a week into 2025, and yeah, we absolutely got a lot to talk about. At the end of the video, we're going to show you a video of part of the CES meeting in Las Vegas from NVIDIA. I think a lot of people are just kind of washing that under the rug, and there is a lot of information in that meeting from NVIDIA CEO, and there's a lot of information we're going to talk to you about and hopefully teach you some things here and help you out. But definitely a lot to talk about. Tesla has been crazy. NVIDIA has been crazy. It's going to be another crazy week, and we're going to look forward into what happens in 2025.
Yeah, I totally agree. The video we're going to show you guys in a little bit, it kind of makes me feel like iRobot-y, where I feel like us as humans, we're kind of going to be obsolete in a way or potentially replaced by these robots and AI in the future. I feel like it's really important to position yourself to capitalize on the future and not get left behind. So we'll get into that in just a second, but let's do some just general housekeeping things with the stock market right now. So the fear greed index for the stock market right now is in the 32 category right here. So when we're in the fear category, like I say right here, be greedy when others are fearful. So people are people are fearful right now. So that's when we want to be greedy. But I feel like this needle's a little bit too optimistic. I feel like we're somewhere more in a neutral category right here. So basically, what this is implying is the market is saying we're in a fear category, but really we're not, because I feel like there's a little bit of trouble on the horizon with inflation being a little bit sticky. And you can see on this chart right here. So right now we're at 2.7% on inflation, but you can see this tick up right here. And the problem with this tick up is this tick up is also correlating to right here, where this is the 10-year bond. So we're seeing a tick up in the treasury bond yield right here. So it's interesting because the bond yield in about 6 months ago was roughly 3.6%, and now we're at 4.6%. So we went up 1% on yield, but at the same time, the Fed cut interest rates by 1%. And the reason why there's that disconnect is because the market doesn't really believe that we're going to have inflation conquered. And I know you're probably wondering, like, Brandon and Cole, why do I care about this stuff? And this is absolutely everything, because interest rates are like gravity on the stock market. So if interest rates go up, that's going to put pressure on stocks to go down. So that's what I said right here. If yields go up, that puts pressure on stocks to go down, because bonds and stocks are going to compete with each other. So if you're in a camp that you think inflation is going to stay high, that means that the Fed has got to stay higher for longer on interest rates, which is right here. You can see they did a little bit of a cut. This chart since 1955 right here. So it went way up and then way down, and we're kind of right in this category right here. But if inflation stays high or it doesn't get to the Fed's target, we probably will stay higher for longer on this rate. And if that happens, the market will probably correct a little bit lower. And if we go to a 1 month chart on Triple Q, for example, this follows the NASDAQ, you could see December 17th, this was the last Fed meeting. We went from 535 all the way down to 514 in essentially 1 day, because the Fed implied they're going to do less cuts going forward. So I know it's not like the sexy thing to talk about, which is interest rates and inflation and stuff like that, but we're trying to help you guys make money. And I mean, Cole and I, we make millions of dollars in the stock market. And these are very, very important things to understand the dynamic of interest rates and how that is gravity on the stock market. So that is something to pay attention to. And then looking at this chart right here, this is called the CME Fed Watch Tool. If you just go on Google, you could type it in. It'll show you what interest rates are expected to be at future meetings, whether the Fed's going to cut or not. So right now we're at 4.25 to 5.5. This is for the December meeting of 2025. So roughly a year from right now, we're only expected to be 25 basis points lower than what we're at right now. So basically, we're almost at the Fed's neutral rate. So the market should plan to get used to the interest rate level that we're at right now. And I think that's why we're seeing a lot of volatility. The market doesn't really know how to digest this data, but it'll take a little bit of time, I think.
Yeah, definitely. Just, I know we've only been 9 days or 8 days into the new year, but we've seen a lot of up and downs, especially over the last month. Nothing, we're not seeing a trend up, we're not seeing a trend down. We're just seeing a lot of ups and downs, and that goes to the yields too. You always say that when there's another option out there where you can get guaranteed money, some people will tend to take that. If you could get, if you were guaranteed 2% versus maybe a 10% at a risk, you're going to take the 10% at a risk. But if you could get a 5 or 6% guaranteed versus a 10% risk, it might influence your change. And I know I was just looking on my phone before this podcast. A couple months ago, CDs were at 3.5%. Now some are, I've seen 4.5, 4 to almost 5%. So Feds are cutting rates, or implied to cut rates, and now they haven't, and now bonds and CDs and yields are up, which gives investors another alternative of a safer return, especially when we're not setting a trend of whether we're going up or down. Right now we're kind of just bouncing, and people want consistency, and I think that's going to be, that's going to throw the market off, or at least take the market some time to settle into what it wants to do and where we're headed.
I agree 100% with you. That was very well said. I say it as like money always wants to find the best risk adjusted return. So the 10-year bond is viewed as the guaranteed risk free rate because if this fails, that means the US government failed and then we're going to have bigger problems than whatever you may worry about at that point. So a guaranteed almost 4.7% you could get right here, or you could buy into the stock market where valuations are a little bit high right now. And historically, the S&P 500, which VOO is my favorite ticker to track, historically this will do 10% per year in the long run. Some years it'll be more, some years it'll be less. But do you want to get a guaranteed 4.7% or a risky 10 at times where there's a lot of uncertainty in the market, times that valuations are a little bit high? This is competition for stocks. So as this bond yield is pumping right here, this is going to continue to put downside pressure on the stock market. But what I talked about in my newsletter from today is it's actually an interesting setup. So I said I think we have one main negative thing for the stock market, which is valuations right now, and there's one main positive thing, and the main positive thing is that the market is pricing in less cuts versus what I actually think is going to happen. So the market's essentially right here pricing in one interest rate cut for the whole year going forward. I think we're going to get somewhere around 3-ish. And when that starts to come through and happens, this yield is going to have pressure to start to fall because this is going to follow what the Fed does with interest rates. So I think that's going to give us maybe a potential surprise repricing of the stock market, meaning surprise pricing to the upside, because bonds are going to be less of a concern. Bonds are going to be less of a desirable thing. So people are going to say, do I want to get a 3.6% bond or do I want to get 10% in the market? That spread will widen and more people want to go to the stock market.
Yeah, for sure. And I think sometimes, I know us personally, and you personally, especially younger people, we want to take that risk. We have a lot more time in the market, age wise, to take a 10% risk. If we weren't to get a 10% this year and we just kept doing it, eventually we're going to get that return. Whereas there's some people that don't have a lot of time, and that's where you have those people that are way more attracted to a 5% or 4.5% bond or a treasury because they don't want to take the risk anymore. Whereas we personally, I'll take the risk. I like to take the risk. I'm going to stay in the VOO. We both love the VOO. We both love the triple Q. So you can't just look at it as, oh, well, I want to take a risk. I don't care about the 4.5%. You got to look at, there's a lot of other people out there who are in different stages of their life that will definitely look at a 4.5% yield or a 5% bond and go, that's appealing to me. I don't want to take any more of a risk. I'm going to stay there. And that's where we get that pressure from.
Yeah, I totally agree with you. Um, let's hop over to Tesla and Nvidia And in a little bit, we'll show you guys a video of, like we said, of the NVIDIA presentation at CES, which I think this could have a lot of downside pressure on Tesla stock. We'll chat about it here and give you both sides of the argument. You guys know that I'm a big Tesla shareholder. Cole is too. I personally have a Tesla, so I love it. But let's hop over to NVIDIA first. So NVIDIA stock's been on an absolute pump cycle lately. So if we go to a 1 year chart, the stock is up 168%. Now people are going to say, dang, it's a $3.4 trillion company. It's one of the largest companies in the world, if not the largest. I have to check the market caps of other companies to see, but it's top three right now. And on a 5 year chart, you can see this massive pump rate here. And people are going to say, man, NVIDIA is a giant bubble. And the thing about Nvidia, and if you like, you got to understand how the future is going to look, and you're really going to have more of a picture of this when I play the video in just a second. But we're in the middle of a massive AI and tech revolution that most people don't realize it's happening because it's happening in real time. I give this example where it's kind of like you have a niece or a nephew, and maybe you don't see them for like 4 months or 5 months. And when you see them, the next time you see them, it's like, dang, how did you get so big? Because you don't see the step change every single day. You see it from 1 month to 5 months later. So you see this huge change of progression. So I think with AI and technology, when we look backwards 1 year, every single year, it's going to be like, holy crap, I can't believe that stuff happened. Like, I can't believe ChatGPT could do all this stuff. I can't believe the progression that has come on Tesla with their full self driving and stuff like that. I remember a year ago with my car, I feel like it would try to kill me every day. And now it's like, it's almost as good as me as a driver. So, and if you keep assuming that rate of progression going forward, it's hard to not expect that Nvidia is going to continue to capitalize on this AI revolution because the more complex that AI and these large language models get, the more computing power they're going to need. And these companies that buy the Nvidia chips are going to want to be able to operate them at peak efficiency, meaning the lowest amount of power, electricity used. They want to run as many as possible. They don't want them to overheat. They want to have the most compute bang for the buck, essentially. And Nvidia is rolling out their new Blackwell chip, which is game changing. It uses 25% of the power that the existing Hopper chip uses. That's the H100. And why would you not want that? Like most data centers right now, they're not necessarily compute constrained right now. They're power constrained, meaning electricity to the building. It's literally as simple as that. They're running massive power off of the grid. So by optimizing and putting in the new Blackwell chips, you're going to be able to have maybe 4 times more chips in your facility. You could 4 times your compute power. And if you're in a competitive niche like large language models like ChatGPT, where Elon is now has Grok going against it. I mean, all these companies have their own large language models, but it's like if you could get 4 times the compute, you could train your model 4 times faster and you're going to be able to smoke the competition. I mean, it's very competitive right now. And I feel like it's just going to generate this never ending upgrade cycle. Kind of like, I mean, iPhone, it's not so much right now, but it's like, every few years you want to get a new iPhone because your phone gets slow and it gets glitchy and stuff like that. So eventually, I feel like that's going to happen with these existing chips that are out there. So heading over to Schwab real quick, just to look at the breakdown on the fundamentals for Nvidia. So people are going to say, "Oh, Nvidia is a bubble right now," but look at their earnings per share growth from 2023 to current, or this is for 2025 expected. Nvidia, just to say real quick, they're already in. They already reported Q3 of 25. They just pull their financial year forward almost a year. They just complicates things, and I don't like it, but that's the way they do it. But long story short, they grew earnings from roughly 17 cents per share to $2.95 per share. So if you divide that out on a percentage basis, that is a massive, massive growth of their earnings. And that's what you see right here. You see massive growth of the stock price. So stocks are going to follow earnings in the long run. And look at revenue. Revenue did a double from here to here, more than a double, did more than double from here to here. And then eventually, maybe it'll do another double for fiscal year 26. But eventually, NVIDIA is going to get into the law of large numbers where it's going to continue to be harder year after year after year to keep doubling. But I do think there's going to be strong growth going forward. Schwab is showing the next 5-year growth rate to be 62% for Nvidia. I think it's going to be closer to 50. I'd like to be a little bit more conservative. But what do you think about all that, Cole?
Yeah, go back to Schwab there for a second, and look at 23 to 24. They had a 584% year over year growth in earnings, and
Yeah.
they're projected another 250% on top of that. So, I mean, those are huge numbers, and their earnings are continuing to grow. I mean, it's not like they're going up from $1 to $2 to $3. I mean, we're talking a
Big time.
huge number, and you look at in that CES meeting what they talked about. It looks like Nvidia is trying to go into many different other markets, and like you said with the Blackwell trip, they're putting into. They're really going back. They started kind of in the computer and gaming industry. They're going back. They're getting better chips for that. In the gaming, they mentioned about creating a desktop computer called Digits, all capital letters, Digits. And now they have a contract with Toyota, where they're going to be using their Orin chips and their automotive operating systems, and to power advanced driver assistance. We don't know what models they're going to be in the Toyota yet. They haven't, kind of announced that, but they did mention a partnership with them. So they're putting their hands in everything, and they want to take it over, and that's why it's such a, they could go so much higher if they continue to grow, and if they get better and they start using these things in other markets. The sky's the limit for them, and I think they're headed on the right track. And that meeting, what he talked about, I think, like I said earlier, people just kind of want one. Maybe it goes in one ear and out the other. It's almost like you said too, is you don't see it right now because you're not looking at it, but it's almost like when people were driving horse and buggy and Henry Ford made the first Model T, people were like, this ain't gonna work. Are you serious? Now look at where we're at. So, but looking back now, you look and you go, oh my goodness, I can't believe we came from this to where we're at now. And 5 or 6 years from now, people are going to say, how are we? I didn't see it coming, but this is what we're trying to tell you. It's coming, and Nvidia is the leader of it.
Yeah, I agree 100%. We'll go into Nvidia partnering with Toyota here in a second too, because that's one of the things that could be a huge implication for Tesla, because most of Tesla's valuation right now is based on full self-driving, like the robotaxi network. And if Nvidia is able to bring out a product and scale it so much faster and get to pretty much autonomous driving in a very fast amount of time, that's going to be a lot of downside pressure on Tesla. But we're going to give you both sides of the argument. There's a little bit of a hiccup to Nvidia, I think, why it's not going to be as easy as they think, but we'll do that in just a second. So Tesla stock, pretty much since Trump got elected to right now, it's been absolutely mooning. Tesla stock is expensive right now on an earnings basis, in my opinion. And the difference between Tesla pump and Nvidia pump is Tesla's pump right here going over to their earnings, like their earnings are actually going down, which they're in the middle of a growth phase. But just looking on current earnings, like fundamentally looking, their earnings are going down and Nvidia's earnings are going up. So Nvidia's earnings are up and the stock is up, but Tesla's earnings are down and the stock is up too. So there's this disconnect between the stock and the fundamentals, and there's a lot of hype and perfection priced into the stock of Tesla right now, which was pretty much this big pump right here. So the problem with companies that pretty much have perfection priced into them is if they don't meet the expectation of perfection, the stock is going to get hit, and it's going to get hit hard. So anyone that wants to buy in a Tesla stock right now, my recommendation is hold it for a minimum of 5 years, because there's a chance that Tesla could be trading at $200 per share 1 year from right now. And I would totally believe that price right there, but it could also be double a year from right now. I don't know. But the name of the game is to buy into a company that has a durable competitive advantage going forward. So I think Tesla does. I think Nvidia definitely does. And you want to get in at a reasonable valuation level. So Nvidia, relative to earnings, it's trading at roughly like a 55 PE ratio. Tesla's PE ratio is 108. So Tesla is trading. So basically, if Tesla were to fall from 400, just say to 200, this PE ratio is pretty much going to be the same valuation level as Nvidia. So Tesla could be 200 bucks per share right now, and Tesla and Nvidia are going to be at a similar price earnings valuation level. And on top of that, Nvidia's earnings look like this, and Tesla's earnings look like this. So that's why, Cole and I would do a lot of options trading too. And, the shares that we own at Tesla straight up, our cost basis is way lower. It's very low. We don't necessarily want to sell our shares because we're in it for the long run. But a way to generate some premium is to sell calls on Tesla right now. I feel like, I've been generating a couple $1,000 a week doing that. So I think that could work out. But do you have anything to add to that, Cole? And then we could head over to the NVIDIA video, and then we could come back and comment on, the pros and cons and what we think is going to happen with that.
Yeah, no, just real quick. Tesla, yeah, like you said, it's priced in for perfection right now. And that's the problem. That's why you see the $25 a share up, $25 a share down. The constant huge volatility with Tesla is where they're pricing into perfection. I mean, one day it opens up pre-market and you're like, oh man, it's $14 a share overnight. Pre-market's ready, and then next thing you know, it's back down $20 a share. So I mean, just a week and a half ago, we were at almost $490 a share, and we're back down to $390 a share. That doesn't, moving $100 a share doesn't normally happen in a week and a half, 2 weeks time. That's the volatility with Tesla. That's kind of where we want to stay away from. We like safer plays. You like safer plays, and that's kind of what Tesla's doing. It's just crazy up and down, and and it's very overvalued. But they're, like you said, they're in a growth stage. They're kind of almost they're coming out of the Model 3, Model Y stage, and now they're going to robo-taxi and some different things. So we'll look to see what happens with them over the time being. But they're definitely in a weird stage for them. I think future looks good. Right now, it's kind of there's uncertainty, but it's just because they're in the middle of two stages, I feel like.
Yeah, I agree 100%. I mean, just look back at NVIDIA stock. Jensen's been there for years. Jensen has stock. I mean, it's split multiple times, but this period from 2002 all the way through here, I mean, the stock went from 11 cents to say 50 cents. So it did a 5x, but to make the big needle mover, it took years of Jensen holding on to that, building all the backbones to NVIDIA, figuring out how to actually make this work until you realize this massive boom right here. So there is a chance that Tesla's in this phase right here. There's this little bump right here. It's bouncing around super volatilely, takes a dip, and then boom, it bangs. And I don't think this huge spike in Tesla right here is going to come until the Optimus robot comes mainstream. I think maybe a bump like this will be like a robotaxi bump. It'll correct down, and then we'll get a huge bump when Optimus the robot comes. But that's not going to happen for years. I mean, I don't see Optimus coming to our houses for at least 5 more years. But when it does come, and if it does come in a mainstream way, everybody's going to want one. I mean, there's billions of people on Earth right now. There's 400 million people in America. Imagine if you had one robot for every human. That's 400 million robots. And if Tesla makes 10, 20K profit on every single one, they're going to have so much money, like they're not even going to know what to do with it. And so are the Tesla shareholders too. So it's like, try to capitalize not on this little bump right here, maybe not even on this little bump right here, but the huge needle mover whale move to come. So maybe Tesla is overvalued here, then it dips in its fair value, but then this massive growth of earnings comes, which is what you see here on Nvidia, and it could pump a lot higher. So just have that in the back of your head. Worry about the long-term move that you're trying to capture. And let's drop down over here and hit this video right here on NVIDIA, and we'll do some commenting at the end.
Omniverse to test drive and generate synthetic data. And drive AGX, a supercomputer in the car. Building safe autonomous vehicles means addressing edge scenarios. But real-world data is limited, so synthetic data is essential for training. The Autonomous Vehicle Data Factory, powered by NVIDIA Omniverse, AI models, and Cosmos, generates synthetic driving scenarios that enhance training data by orders of magnitude. First, OmniMap fuses map and geospatial data to construct drivable 3D environments. Driving scenario variations can be generated from replay drive logs or AI traffic generators. Next, a neural reconstruction engine uses autonomous vehicle sensor logs to create high-fidelity 4D simulation environments. It replays previous drives in 3D and generates scenario variations to amplify training data. Finally, Edify 3DS automatically searches through existing asset libraries or generates new assets to create sim-ready scenes. The Omniverse scenarios are used to condition Cosmos to generate massive amounts of photorealistic data, reducing the sim-to-real gap. And with text prompts, generate near infinite variations of the driving scenario. With Cosmos Nemotron Video Search, the massively scaled synthetic dataset, combined with recorded drives, can be curated to train models.
So it's pretty interesting what they're trying to do there. So basically, they're going to do the majority of their data as simulated, and they're going to pair simulated data with real world data. But here's the problem with it. Like, we all know Elon's been overly optimistic about full self-driving for Tesla when the cars are going to be autonomous and stuff like that. And the reason why is because Elon was seeing the progression of full self-driving from 10% the way there to 30% to 40% to 90%. Like, he was seeing that rapid progression from basically 0 to 95%. And, I felt like they were like 90%, maybe, I don't know, a year ago or a couple years ago, whatever it was. But to go from 95% to 100% or to 99.9%, that last 5% is so much harder to get than the first 95%, because, yeah, these cars are not trying to drive off the side of the road and kill people now, but they don't feel superhuman like yet. I mean, it's getting way better. Like, it's close, but it's taking so much more time to go from 95% to 100%, which I think they're going to get it. But here's what I'm trying to get at. NVIDIA, I feel like what they're trying to do, they're going to be able to get from 0% to 95% quick. I mean, probably in a year, to be honest with you, not even a year. But to go from 95% to 100%, where people have the confidence to get into a robotaxi with their family, with their kids, take that to an airport at night when it's raining, it's going to take time. It's not going to happen as fast as people think. But I think that this could only help Tesla too, because Tesla could potentially do some sort of team up with NVIDIA, which they already do. Tesla uses all of NVIDIA's chips to train the Tesla full self-driving software. But, there could be additional partnerships with NVIDIA and Tesla where maybe Tesla uses them to get from 99% to 99.5, whatever it may be. To help train that, and then to train the Optimus robot, stuff like that. I just think that NVIDIA knows that this is the future and it's coming. And I think that Tesla has its own competitive advantage right now. But I do think in the future that advantage will narrow. But, it's all about the first mover advantage. I think Tesla is going to be the first one to be able to scale a product, an autonomous car mainstream, because you got to understand, like Cole was saying earlier, Toyota partnered with NVIDIA to be able to push out, they're going to partner and do that software and have their cars full self-driving. But the problem is Toyota has none of these cameras, hardware, chips, whatever in their cars yet. It's not built into the production lines. It's not incorporated yet. So by the time that you do that and then produce these cars on a mass scale, it's going to be years. And Tesla already has millions of cars that are fully equipped to be able to get full self-driving and do this autonomously just with the software update. So Tesla could flip a switch overnight and say, okay, go do it. But all these other car makers, they have to then go build the cars and get them on the road. So they're going to have a lot less real world data also, because there's not as many cars. Like Tesla Model Y is the number one selling car in the world. That's the number one car selling in the world, is collecting the most amount of real world data. So we'll see how this happens, but I think it's big for NVIDIA. I think there's going to be Tesla full self-driving, and then there's going to be everyone else that just goes with NVIDIA or licenses Tesla's full self-driving.
Yeah, I think that's kind of where we're at. Tesla, it's good to be first, and it's good to be good and continue to grow, and that is what Tesla has in their back pocket, is being first, and they're way far ahead, and they're doing it the best. Um, and I know it's kind of weird because we both came from small towns, or a small town in Ohio, and you're on the West Coast in a big city now. I'm on the East Coast in a big city now, and you know, I, I never seen cars that drove themselves, and now you're in a big city, and it's like, I was just in San Francisco not too long ago, and pull up to a red light. I'm in a rental car, and there's a guy sitting in the back seat of a car, and nobody's driving. But you don't see that where we were from. You know what I mean? It's not common, so people kind of can't wrap their heads around it until you actually see it, that there are cars out there driving itself. And I'll be excited to see what Toyota has to offer moving forward with NVIDIA. But it's like they teach you to, in driving school, expect the unexpected. And with Cosmos, they're taking every video that they could find, every single training opportunity that they could find. They're putting it in, it's teaching itself, and then they're running a simulator on it. Then it's reteaching itself again, and it's continuing to learn. And that's what's going to be really cool to see, is how far it learns and how far it grows. But yeah, crazy where we're at, to where we were to where we're at, and definitely going to be crazy in the future. It's coming. I mean, it's here and it's coming. But yeah, that's all we got for you today. Brandon, if you want to close us.
Yeah, that's pretty much wrapping up episode 4 with you guys here. We're going to do an episode once per week. Our goal is to give you guys as much value as we can, just to go through things that are needle mover things in the stock market. Cole and I generate thousands and thousands of dollars every single month with stock options and stuff like that. We'll start to go more into that stuff. Just leave comments below if you want us to really go more into our strategies and what we do. But with that being said, we'll see you guys later. We'll see you guys next week. Have a good weekend.